Hey there. Today, I'm going to show you how to analyze financial statements like a pro. Whether you're an investor, a financial analyst, or just someone looking to understand a company's financial health, profitability, and overall performance, this guide is for you. First up, the balance sheet. Think of it as a snapshot of a company's financial position at a specific point in time. It tells you what the company owns, what it owes, and the shareholders' equity. Let's break it down. Assets. These are divided into current assets like cash and inventory, and non-current assets like property and equipment, liabilities. These are the company's obligations, split into current liabilities like short-term debt, and long-term liabilities such as long-term debt. Equity. This includes common stock and retained earnings. Here are two key ratios to know: the current ratio, which is current assets divided by current liabilities. For example, if a company has $200,000 in current assets and $100,000 in current liabilities, the ratio is 2:1. That's solid short-term financial health. The debt-to-equity ratio, which is total liabilities divided by shareholders' equity. If a company has $500,000 in liabilities and $1 million in equity, the ratio is 0.51. A lower ratio means less reliance on debt. Next, we've got the income statement. This statement shows the company's revenue, expenses, and profit over a specific period. It helps you assess profitability. Key components here: revenue, the total income from sales; COGS, which are the direct costs of production; gross profit, which is revenue minus COGS; operating expenses, the cost to run the business; operating income, which is gross profit minus operating expenses; and finally, net income, the profit after all expenses are deducted. Two important ratios: the gross profit margin, which is gross profit divided by revenue times 100. For example, with $1 million in revenue and $600,000 in COGS, the margin is 40%. The net profit margin, which is net income divided by revenue, times 100. If net income is $100,000 on $1 million revenue, the margin is 10%. Now let's talk about the cash flow statement. This tracks the flow of cash in and out of the company, showing how well it generates cash to pay debts and fund operations. Key components include operating activities, cash from core business operations; investing activities, cash spent or generated from investments; and financing activities, cash from issuing debt or equity. Two key ratios: the operating cash flow to net income ratio, which is operating cash flow divided by net income. For example, with $150,000 in operating cash flow and $100,000 in net income, the ratio is 1.5. Free cash flow, which is operating cash flow minus capital expenditures. If operating cash flow is $200,000 and capital expenditures are $50,000, free cash flow is $150,000. To sum it up, assessing a company's financial health involves looking at trends over time and comparing them to industry benchmarks. Thanks for watching. Don't forget to like and subscribe for more financial insights.